Hey guys, welcome back to the third session of Chapter 2. In this session, we're going to have a look at the test result that might show consistency or inconsistency with a certain form or status of market efficiency. Now, we are only gonna focusing on semi-strong form EMH and strong form EMH in this session. So, when we test whether a market are more, let's say, approaching to the status of semi-strong efficiency, we normally use time theory analysis and cross-sectional analysis. So, these are tests that are based on the timeline, or the, let's say, cross-sectional analysis is more like test that runs on the specific characteristics of a listed firm. So, the information they use are either past information, so that's timeline analysis, and also public informations about a firm's characteristics, such as its leverage, its size, the listing time, and others. So, that later part of information are cross-sectional information that are generated by a certain aspect of a listed firm. Now, if the market is indeed in the status of semi-strong efficiency, then past information and known public information should have no predictive power over future returns. So it means that if the market is in the form of semi-strong efficiency, the information used by time theory analysis and cross-section analysis are actually already reflected in the stock price. So any analysis based on that shouldn't identify any abnormal returns. But the rejection rule is if, following these studies, we indeed find abnormal returns, then it contradicts the status of semi-strong efficiency. Now, we don't just use a time or cross-section analysis. We also use event study. Now, event study is a known and very, let's say, mostly used testing result in economic or, let's say, financial world. So what we do is we set an event window for the test event. So it's a time window, and we try to identify any abnormal stock price movement within this time frame. So if there is abnormal return, then we could say that abnormal return are likely to be led by this event. So that event has information effect, or let's say predictive power, or let's say it's a determinant of stock price. Now, what we suggest by semi-strong form efficiency market is that we expect once information is released to the market, it was instantly reflected in the stock price. So, even if you use this new information to trade, it wouldn't lead you to have any abnormal returns. But if, when we use event study and we detect the abnormal returns, it means that this, let's say, this market is not in the form of semi-strong form efficiency, because if it is semi-strong form efficiency, this event wouldn't lead to any abnormal returns. All right, let's look at some of the results that are tested on semi-strong form efficiency. The first part of the result are given by timeline analysis. So, they normally use earnings report. We know that firms tend to release their financial statement, their annual report at the end of financial year. And also, listed firm issue a, let's say, quarter report, financial report, that covers their operations, their outcomes are given by operations from the last quarter. So the test result indicates that if there is a large and also unexpected changes in earnings, it's likely to lead to abnormal returns, and half of them are actually identified after the announcement. Now, unexpected large change tend to lead to changes in, let's say, in the same direction in stock price. So it means that if there is an unexpected decrease in company earnings, then it's likely to lead to a decrease in stock price. If it's the other way around, it's gonna lead to an increase in stock price. So that's the conclusion. And also, we find that the unexpected earnings can explain up to 80% of the stock price movement. So that means it has explaining power over stock price movement. It is a stock price determinant. So this indicates that the change in firm performance, when the information is released, it is not instantly reflected in the price performance. Otherwise, we wouldn't observe 50% of changes happened after the announcement, or we wouldn't observe the unexpected changes in earnings to be able to explain the stock price movement. So these timeline analyses regarding earnings report are contradicting to the prediction given by semi-strong form efficiency. Now, there are other types of timeline analysis. Some of them are referred as calendar effect. It's quite interesting. The most famous one is the January anomaly. The January anomaly shows that the stock that earns negative returns from the previous year tend to outperform itself in next year's January. Why? Because of tax selling. If the market is semi-strong efficient, then the calendar month shouldn't have any, let's say, association with the price movement. And there's also the Monday and weekend effect. It shows that the returns are likely to be negative on Mondays, but it has some difference between large firms and small firms. For large firms, the negative returns tend to be observed once the Monday market opens. So it is indeed a weekend effect because that change already happened during weekend. Well, for small firms, this negative effect are more likely to be observed after the Monday market opens. So for small firms, it is indeed a Monday effect. And also, we can see that the cumulative advance of stock performance tend to, let's say, gathered around the first half of a trading month. Now, if the market is semi-strong efficient, then public information such as a calendar or weekday shouldn't have any predictive power over stock price. But we did find this evidence. So this evidence indicates that the market is not in the status of semi-strong form efficiency. Now, let's look at some cross-sectional results. So these are the results given by testing on specific firm characteristics. The most famous one is the size effect. It indicates that small firms tend to have higher risk-adjusted return than larger firms. Now, why is that? It's because the quality of information. For small firms, there are higher chance of information asymmetry because, well, let's say it is basically led by the attention it draws on the market. Now, the larger firms are more likely to have larger attention from the massive investors and also from the institutional investors, stock analyzed. While smaller firms, it tend to have less investors to follow. So their information quality or information environment is inferior compared to large firms. So when there is a gap in the information, there is a gap for abnormal returns. Because if you are superior in investment analysis or information detection, then you get the information that are not available to others, which are more likely to happen among small firms. Then you can have access to abnormal returns. So that's the basic reason behind the size effect. Smaller firms tend to outperform large firms. Now, if the market is in semi-strong form efficiency, then the size effect, which is a known factor of a firm, shouldn't have anything to do with abnormal returns. But we find it so. This result contradicts semi-strong form efficiency. So, we need to pay attention to the size effect. It is not stable from year to year. So if you want to trade based on this size effect or size anomaly, just pay attention to the year effect. Some other evidence from event studies. The first is stock split. Stock split is a cosmetic move of firms actually, because it really doesn't have anything to do with the change in economic value. So it's just split what you have. Let's make an example. For example, you have half cake, and stock split is like you cut this half cake into equal parts. That's 2 quarters. Now, if you don't eat any of the cake, you still have 1 half cake that are joined by 2 quarter cakes. So nothing really changed. And that's exactly the same with stock split. So, stock split won't lead to any change in economic value. It won't have any economic effect. So, it shouldn't lead to abnormal stock returns. Well, it turns out it have some abnormal returns, but before the announcement. So it indicates some sort of information linkage, but regardless of when this abnormal return take place, what we concentrate is whether it take place. If it take place, it contradicts the semi-strong form efficiency. And it is. So the other type of event study focusing on initial public offering. So that's IPO. It identifies a significant, let's say, stock underprice. So it is underpriced by 18%. So what does it mean? So it means that let's say, the stock price on the secondary market, if it is $1, then before it was released to the secondary market, it was released to the primary market, right? So it means that when it was released to the primary market, its price is 0.82. So that's what underprice means. It means that the price on the primary market is lower than the secondary market. So if the market is semi-strong form efficient, then there won't be much of a, let's say, stock price change between the primary market and secondary market. But we observe this 18% underprice on the primary market. So that's let's say, that opens a window for opportunistic transactions. Even though this underprice is adjusted within 1 day, it disappears at the end of this trading day. It still leaves a wide open timeline for those who are, let's say, active in detecting any misvalued security. Now, not all the evidence from event study contradicts the prediction in semi-strong form efficiency. We actually have some consistent result. So the first one is stock price react, let's say very instantly, let's say relatively instantly, to world economic event. Why? Because if we are looking the economy in the, let's say, perspective from the world, then we know in the world there are many active and professional investors who are always making the rational investment, the rational trading behavior. So that's why in the world, the price can quickly adjust to such events. So if a worldwide change happened, then it wouldn't lead to any abnormal returns. So this fit the prediction of semi-strong form efficiency. Now, the next evidence that support semi-strong form efficiency are accounting changes. So announcement of accounting changes doesn't seem to lead to higher, abnormally high returns. So what are accounting changes? So this refers to, let's say, a change in the depreciation method, a change in the inventory management method. So these accounting changes don't have economic value changes. So that's the basic reason why they shouldn't lead to change in stock price. Even though, let's say, a change in depreciation method might lead to a change in earnings, but this change in earnings is merely an effect of accounting changes, not because of economic value changes. So it doesn't lead to any abnormal returns. It fits the prediction of semi-strong form efficiency. Now, the stock price also adjusts rapidly to firm events such as acquisitions, mergers, and also some type of offerings, both IPO and secondary offering, because these price changes tend to, let's say, end within just one day. So that still fits the prediction of semi-strong form efficiency. Now, let's look at the test result on strong form efficiency. The most distinctive feature of strong form efficiency is that it can reflect private information. So private information are likely to be held by company insiders, such as top managers, board, or affiliated investors. And also, it applies to the outsiders but with proficiencies, such as the security analyst and also professional money managers, or even some institutional investors. These are the investors that are likely to hold private information. So we can simply test out whether investors that are likely to hold private information can have abnormally high return. Those are higher than risk-adjusted returns. So if we identify that these investors who are likely to hold private information are having abnormally high returns, then we'd say this contradicts the prediction of strong form efficiency. Now, even if these investors who stand at an information advantage still does not have a larger chance to win the abnormally high return, then we can say this is consistent with the prediction of strong form efficiency. Now, the real world is never a black and white type of situation. So it was never totally inefficient or fully efficient. it is more likely in the middle. So this result gives us some guidance that allow us to use these market anomalies to get abnormal returns. So if we only trust the market to be fully efficient and all we do is just buy and hold, this may not fit all the investors' need. So these studies provide a, let's say, action guide, and hopefully we can have it blessed in the investment world. All right, that's the end of this session. In the last session of Chapter 2, we will have a look over the human factors that are likely to induce the market anomaly or lead a market to away from its efficiency. All right, see you next time. Bye-bye.